Welcome to Market Catalyst. I'm Julie Hyman, and we are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, the turnaround at Target gets underway, but Wall Street isn't celebrating it. We'll have details ahead. Plus, the U.S. weighs taking a stake in Intel, but what are the terms of that deal, and what are the implications for other chip makers? More to come. Plus, Toll Brothers offering a disappointing outlook on the housing market. Is it all bad news? We'll discuss that and more on Market Catalyst. First up, though, let's get a check on the markets. A day after we saw a steep sell-off in tech shares in particular, we're looking across the board. Now, first here we have the Dow, which is little changed at this point. The S&P 500, ever since the open, we have seen losses deepening, but I really want to zoom in on the NASDAQ. Right now, it's down 1.25%. And as you can see, since the open, we saw it sort of take that sharp leg downward. If you look at the two-day chart, you see that incorporate the selling that we had yesterday and then the further leg downward today. So the two-day loss is now amounting to 2.8%. Then take that to 5 days, and we see here the 3.2% declines that we have seen in that tech-heavy NASDAQ. So there didn't seem to be a particular catalyst. As you know, the sort of drumbeat of concerns over tech valuations has been getting louder, and so that may be something. But as you also know, if you've been watching the show for any length of time, valuations alone do not usually a catalyst make. But we'll discuss this more, of course, over the next couple of hours. And then also, as we zoom in on the NASDAQ, we've got to look at the specific stocks and what is moving here. Darker the red, the bigger the decline we are seeing here. And of course, Palantir stands out, down 5.3% today. If you look at the 5-year chart for that one, you get a 19% drop. However, still, if you look at year to date for Palantir, you see a doubling in the shares before this latest leg downward. But Palantir has sort of been one of the poster children, if you will, of these concerns over AI, over valuations, because its valuation is so high and because we have seen this run up year to date. So that's one to continue to watch. When you look at the other large cap tech names, they are also seeing declines. Nvidia down 2.4% ahead of its earnings after the close a week from today. And then we have the others as well. Broadcom's another that's a deeper red, down 3.5%. So we'll continue to focus on what's going on in tech. But we also have to turn back to retail there because that's been a big story as well. Target shares plummeting as the company names the successor to longtime CEO Brian Cornell. Target insider and current chief operations officer Michael Fidelki is going to take the helm. That starts February 1st of next year as the company looks to turn around its sales slump. Joining me now, Bill Kirk, Roth Capital Partners senior research analyst, and David Bellinger, Mizuho America's director and senior analyst. Guys, thanks for being here. David, I'm going to start with you. You guys did some survey work, right, on what people wanted in a new Target CEO. And it was emphatically not an insider, right?
Yeah, that's right. Thanks for having me on. So about a month ago, we did this survey. We polled 50 plus large investors looking at the consumer sector who are familiar with Target, and 96% wanted an external hire. So that it gives some credence to the move today. We basically heard that Target needed someone new to bring wholesale change. You have this announcement today with Michael Fidelki, the COO. He's been at Target for 20 plus years. He was actually an intern at Target a long time ago. So he's stepping into this role beginning of next year. But you can see by the market reaction today that people wanted some type of more forceful change, maybe a more aggressive posture from Target. And it looks like we just haven't gotten that yet. Fidelki, he could be great in the role, right? We don't know a ton about him. I haven't met him, but he could do well. It doesn't seem to be what investors are looking for today, and I think that explains the stock move.
Yeah, and the backdrop, Bill, of course, is that the company's comparable sales were down 2%. And, Fidelki's been there, right? And not only has he been there, he's been put in a position more recently to try and help the turnaround. So what do you think are his chances here?
Well, I think your setup's completely right, and David's spot on. Comparable store sales are in decline. Gross margin is contracting. Earnings are down 20% year over year. Simply put, that's not a healthy company. So they need to do something dramatic. And the issue that the internal hire presents, or the internal promotion presents, is does he have the willingness to do something dramatic? We believe they've underinvested on a number of fronts, particularly IT and supply chain technology, even price points. And it'll take something dramatic to reignite that growth that he seems very focused on. He's focused on the right thing. It's return to growth. But is he willing to step up that investment to cause that short-term earnings pain to ignite that growth. And that's where investors and analysts frankly are struggling to figure out. And in fairness, he has time to show us that he's willing to. He doesn't start until February, but that's the big question out there for the whole community.
David, in your view, what is something dramatic from Target? Do you think that's what is needed to, and what would that be?
Yeah, we'd like to see them take some big swings, whether that's grocery or the e-commerce business, areas where they've been really lacking a Walmart over the years. And if they come out and pick a lane and take a big investment swing on some of those, it'll be extremely expensive either way they go. But I think that's what people are looking for, because there's a lot of different angles that they could go here, merchandising or those other two, but to do all those at once can be incredibly disruptive. So we'd like to see them pick basically one key strategy, go for that. And the other thing I'll mention here too is that trying to turn around this business in real time is very difficult, and there's a lot of disruptive forces on the profitability side. So I feel like we haven't had our kitchen sink moment yet for Target, and this earnings guidance for the back half of the year could be at risk, or you have a light guide into next year as well. So we're still neutral, and we'll give it some time, but it doesn't seem like it's an immediate lift to earnings.
And among those risks in the second half of the year, it is seen as more exposed to tariffs than a Walmart, for example, because of the mix of where it gets its imports from. Can it, how quickly can it diversify its supply chain, for example? Is it even trying to do that?
Yeah, it's exactly right. All these companies have been trying to do this for a few years now. Still a big China exposure for Target, leans more discretionary, and nothing to complicate your turnaround like the implementation of tariffs on top of everything, right? So you've got questions of what can they do internally, plus how are the consumers digesting all of these tariffs? So far it's been fine, but you've got more potential price push through in the back half of the year that could just be a wild card basically for these guys.
Yeah, and Bill, on the flip side, we could be getting some rate cuts coming. Is that something that, just as some of these negatives are going to hurt Target more, is there more potential for them to benefit when that starts making its way through?
Sure. I mean, naturally, if the consumer were to get better, particularly in discretionary categories, that would benefit Target in a disproportionate way, the same way it's hurt Target on the way down in a disproportionate way. So absolutely that would help. What we're seeing though is them just really fall behind some of the leading peers, in particular Walmart. You can just look at digital sales, e-commerce sales in the period for Target, only 4%. Walmart reports tomorrow, but it'll probably be greater than 20%. Walmart's business for e-commerce is already far larger, and it's outgrowing Target's. So that moat is just getting wider and wider. And it really goes back to how they've spent money over the last few years. They spent roughly $5.5 billion over the last 3 years on like supply chain or IT improvements. Walmart spent $35.5 billion. And so Walmart is just really outspending them. And we think one of the bigger mistakes that Target made was back in 2021, late 2021, early 2022, they did $10 billion in share repurchases at prices obviously far higher than where the shares are today. But that $10 billion, that should have been used to go after Walmart, to try to close the technology gaps, the supply chain gaps that Walmart's developing. And it was used in a less productive way.
Guys, final question on Target before I want to just zoom in for a moment on Walmart. Bill, first you, like Target, the brand, the strength of that brand that I remember as that Target sort of cachet, is that re-achievable?
It's harder because COVID forced a lot of shopping online. So you used to have to go in the stores and feel that experience. When COVID forced a lot more consumption into online channels, that cachet that the stores may have had is less important, right? The business becomes more commoditized. It's where are you on price and where are you on your logistics ability to get the delivery fulfilled. And so that shift, COVID forced that shift, took a lot away from what maybe made those stores special and put the shopper somewhere else. So in that sense, it is hard to kind of recreate that magic. And it's such an intangible strategy that I'm not even quite sure necessarily what it means, right? Like they say we're going to bring back the Target magic. and I don't quite know what that would entail.
David, what about you? What does Target mean to you?
Yeah, it's all about great merchandising. And I think one thing they lost, they had a lot of work from home over the last few years. That was one of the topics addressed on the call today, is that a lot of these merchants will be back in the office. We've seen that happen with Five Below also. They had some issues where the merchandising essentially got away from them. You're seeing same-store sales very negative. Now Five Below's doing really well, probably going to do a double-digit comp this quarter. So it's not easy to turn it on. And we've heard, too, that Target's lost a lot of key merchants, probably over to Walmart and other retailers. So to recapture that magic is definitely possible. There's probably something like 50% upside in the stock if they can put that together. But it's not easy to do it overnight. It's sort of this slow build, and maybe Fidelki's the right guy, but it'll just take some time. And to try to capture that in a very quick way is hard. They were talking about having more tech investments, initiatives, AI to pick up on these trends. So maybe we'll see that as it develops.
Maybe. We should tell viewers, by the way, both of you guys are neutral rated on Target. So obviously you feel like you need to see more before you get more positive here. We got to leave it there. Bill, David, thank you so much. Appreciate it.
Thank you.
Thank you.
Coming up, we'll be talking more about Intel and its potential partnership with the United States. We'll be right back.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We are live at the NASDAQ. Let's get a quick check of the latest market action. We're about 1 hour into today's trading session, and now we see all three major indices in the red after the Dow, as you can see on the YF Interactive, opened in the green, now is flipped into the red as we make our way into today's trading session. The NASDAQ leading the downward momentum, down about 1.6%, similar to the losses that we saw on Tuesday when the NASDAQ fell about 1.5%. That was the biggest loss in 2.5 weeks. And now we're seeing that continue today into today's market session, and the S&P 500 also falling lower, down about 0.8%. As you can see here, the NASDAQ, we take a look over the past 3 days, you see that downward momentum. And really, this is largely because of this rotation that right now that we're seeing from investors. You could see this major sell-off in tech, down about 2%. In the last 3 days alone, down nearly 3.5%, as consumers have, or rather investors have, this fear of this boom, this bubble in AI getting too overvalued. As you can see, investors here really turning towards consumer staples, towards sort of these safer trades, up about 1.8% in the last 3 days. I also want to take a look at what exactly is leading the downward momentum for the NASDAQ. As you can see, these larger tech cap companies have been leading the downward momentum. Nvidia down nearly 6% in the last 3 days alone. You also have a company like Palantir that saw its worst day on Tuesday since the end of June. That stock down nearly 18% in the last 3 days alone, and that downward momentum continuing this morning, down more than 7.5%. But on the flip side, there is some stocks in the green. You have PepsiCo, you have Costco, you have some others that are really part of those maybe consumer staples, discretionary, getting some attention right now. But once again, taking a step back, we're seeing this rotation in stocks, and that's leading the downward momentum. The NASDAQ down nearly 1.7%. But keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout today's trading session.
Now time for some of today's trending tickers. We are watching Analog Devices, Guess, and La-Z-Boy. First up, Analog Devices shares gaining today as the company posted earnings that showed robust demand. The analog chipmaker's third quarter results and outlook came in strong above consensus, according to Truist. Next up, Guess, the gene maker going private in a $1.4 billion deal with Authentic Brands. Guess has been restructuring its operations in an effort to boost productivity and integrate Rag & Bone, which the company acquired last year. Authentic Brands has built a portfolio of more than 50 fashion, celebrity, and media brands through acquisitions. Those deals have included the purchase of Dockers from Levi's, Champion brands from Hanes, and Reebok from Adidas. Its CEO has said he's considering taking the company public in 2026. And finally, La-Z-Boy. Shares are plunging after the home furniture retailer posted weaker than expected adjusted earnings per share numbers as higher expenses weighed on earnings. KeyBank analysts noting that the recliner company fell short of its tepid pre-announcement as well. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. The Trump administration is considering taking a 10% stake in Intel in exchange for some of its CHIPS Act funding. And that could be just the beginning. Officials are reportedly eyeing stakes in other chip makers that have received funds, including Micron, Taiwan Semiconductor, and Samsung. That's according to reports from Reuters. This all coming as part of a series of unusual deals between the White House and big tech. The administration agreeing to let Nvidia sell chips to China for a 15% cut of the proceeds. And Apple has promised $600 billion in U.S. investments over the next 4 years, cemented by CEO Tim Cook's Oval Office visit, complete with a U.S.-made souvenir for President Trump. So what does this latest report say about the administration's relationship with corporations? Here to discuss, Gautam Mukunda, lecturer at the Yale School of Management, and Bob O'Donnell, Technalysis Research Chief Analyst. Guys, thanks for being here. Bob, I want to start with you. When we look at the landscape of the companies that have taken CHIPS Act funding, who should we be zeroing in on now as now potentially having some kind of partnership with the government?
Well, obviously, I think you probably look at the U.S.-based ones, because I think it's going to be pretty hard to convince TSMC and other companies from outside the U.S. for some of these deals. But so, I mean, it's going to be Micron, there's Global Foundries, there's TI to some degree, although they got a much smaller amount. So, I mean, I think that's probably where it ends up. But look, I mean, the bigger issue that we have to be talking about is this really the right thing? I mean, you know, the government has given subsidies to farmers and to all kinds of other industries, and there's never discussions of payback and investment there from an earnings perspective. And I think it raises some very serious questions that we need to be thinking about, because there's potential long-term implications here that I don't think are very good.
On that front, I was struck by a column from Greg Ip in the Wall Street Journal that was out about 10 days ago, even before this latest round of talk about Intel. And he wrote, a generation ago, conventional wisdom held that as China liberalized, its economy would come to resemble America's. Instead, capitalism in America is starting to look like China. And Gautam, I want to bring you in on that. Companies don't seem to be raising a big ruckus here, because those that have gotten, sanctioned in various ways, right? So how do you think this will work between the government and Intel or whoever else?
Yeah, companies are objecting because they're afraid. Like, it's really just that simple. And CEOs of major corporations think of themselves as some of the most powerful people in the world, and in many ways they are. But if you compare even the most powerful CEO of the biggest company in the world to the president of the United States, you're comparing a pygmy to an elephant. There's just not even a competition. And so this is a president who's demonstrated over and over again that he's willing to use the powers of the federal government, even illegally use the powers of the federal government, to punish people who he doesn't like and who disagrees with, or, on a whim. And CEOs individually are all saying, look, I can't play that game. Collectively, they might be able to stand up to him, but strikingly, the organisms of collective action, the Chamber of Commerce, the conference board, things like that, are just not standing up and acting as organizers to get CEOs to rally together and use their strength collectively.
Well, it seems like in part, Gautam, it's because maybe they're getting some benefits from this as well, right? In the case of Intel, yes, it got that $2 billion infusion from SoftBank, but if it does strike this deal with the government, is it more of an advantage than a disadvantage?
Intel clearly has had some troubles over the last few years, but I don't think they're so desperate for cash that they need this $10 billion from the government, when what you're doing is essentially letting Howard Lutnick and Donald Trump into your boardroom and allowing them to dictate the future course of the strategy for your company. They're making claims about they're going to be non-voting shares, but nobody believes this, right? It's completely implausible. And so even apart from the national level issues where the federal government is not capable of administering this, doesn't have these abilities, none of these things make sense. From an individual level, being the temporarily fostered patron of the Trump administration might be good for a week or two, but I think Lip Bhutan knows better than anybody, right? That a few weeks ago, Trump was calling for him to be fired. Now he's the favorite child. Next week it could be something else, and no company can be run like that.
Bob, what do you think here? Because you've said also that Intel is essential to American security. So there is that sort of argument to be made that this is in the national interest to build this strong homegrown chip industry.
It absolutely is. And I completely agree with what was just being discussed because, look, it's these changes all the time are just untenable for long-term success. And when we think about the critical importance that semiconductors play in the entire economy, we always talk about it being tech, but remember that semiconductors are in cars, they're in washing machines, they're in pretty much everything. And all of those things are driven by technology advancements. And right now, the most advanced technology in the US is made by Intel. And they've been making these investments to enable other companies to leverage them because not only are there geopolitical issues, there's just the basic practical issue that you've got one company, TSMC, that owns essentially almost 100% of the most advanced chip making, manufacturing capacity. That just doesn't make any sense from a supply chain perspective at all. You need diversity. You need manufacturing in the US because semiconductors are going to be critical moving forward. You can't just take another company and say, oh, well, you can be the next Intel. There have been decades and decades of work done to get to where they are. These things don't change overnight. So I think it's essential that the government does provide some subsidies. Maybe they encourage other US companies to work with Intel. That's the piece that Intel needs for their foundry business to really move forward, to nail an Nvidia, an AMD, an Apple, a Qualcomm, these kind of companies to do some work with Intel in their foundry business. That could really turn things around and then start to see a more diversification across the supply chain, which is really essential, again, not just for the US, but for the global semiconductor industry.
So, Bob, just quickly then, do you think that, it sounds like you do think there's a need for the homegrown industry. What else needs to be done to accelerate and expand that process?
Well, like I said, there are other factories we have here in the U.S. We want to see more focus on companies like Global Foundries, obviously Micron, but Micron specific because they're doing memory. Global Foundries is also limited because they're not doing the most cutting edge process, but they're doing very important work. And so if there's anything that could be done, it would be, hey, why not provide monetary incentives from the government to U.S. companies to say, look, we're going to encourage you to invest in U.S. companies. Because, for example, Lisa Su from AMD said even buying chips from TSMC made in the U.S. is going to cost more than chips made in Taiwan. So maybe the government covers those kinds of differences to encourage these companies financially to make those investments. So that's the kind of developments I would like to see, and I would hope we would see something like that moving forward.
Yeah, this administration seems to be more stick than carrot usually, but we'll see if that happens. And Gautam, finally, out of all of this, what is your takeaway in terms of the biggest lesson for CEOs when dealing with this administration?
They can make short-term deals, but they will come around and bite them because this is not an administration that has a coherent policy framework or that sticks to it for any longer than it takes to type out a tweet. The basic problem here is, so just on the simplest level, right now, if you're importing chips into the United States, you face one tariff regime. If you import chips that are wrapped in, say, $5 of computer equipment, so they're inside a computer, you have faced a completely different tariff regime. And so there is no coherent model of policy that gets you to any goal there that makes any sense other than everything revolves around the whim of the president of the United States. The consequences of this are really large, and CEOs, at some point, CEOs need to realize that they either need to stand together or they're all going to hang separately, because this is going to keep happening to them until they sort of gather their forces and stand up with each other instead of this free-for-all.
Bob, Gautam, good to see you both. Thanks for your perspective.
Thanks.
Coming up, we're taking a look at Lowe's latest earnings report as it seemingly shakes off headwinds for the home improvement retail sector. We'll be right back. Shares of Lowe's moving slightly higher after reporting earnings for the second quarter that topped Wall Street's expectations, despite pressures from tariffs and slow housing sales. The company also announcing plans to acquire Foundation Building Materials for $8.8 billion in a play for the professional market. Let's bring in Scott Mushkin, R5 Capital founder and CEO who covers the sector closely. Scott, it's great to see you. You are pretty negative on Lowe's. We should start off by saying here, you've got a sell equivalent rating on the stock. It was higher. It's sort of come down off those highs here. But this did look like a relatively strong quarter, especially when you compare it with Home Depot. What's your read?
So I think our read on Lowe's is, two things. First, it's hard to get involved in kind of the home improvement area, in our opinion, with interest rates stuck, 30-year mortgages stuck at 6.5%. It's just not a great environment. They even talked about that on their call. And I think a second thing that keeps us on the sidelines or even with a sell rating is we do a lot of proprietary pricing work, and Lowe's, the way they position the business, a lot of do-it-yourself, a lot of their goods are you can get at Walmart. And when we run pricing surveys, Walmart is substantially cheaper than Lowe's. And so we worry about the gross margins even as we go forward, even in a recovery. Will they be able to hold those price points? And we see that across what we call everyday essentials. That market is really difficult. And of course, it's not a huge part of Lowe's business, but they do sell things like Clorox cleanup, Tide. Those products are just not priced competitively, according to our research.
And Scott, let's talk about interest rates for a second, because there was a guest on the show earlier who was saying mortgage rates going from 7% to 6.7% is not going to meaningfully move the needle here. And we've been having this discussion recently about, okay, what level is going to unlock this demand, whether it's demand for houses themselves or demand for home improvement. What do you think? Is there sort of that magic number?
Yeah, that's a great question. It's something I've been thinking about all week with Home Depot reporting, more than all week. I think if we get below 6%, that's a good first step. We go below 5.5%. I think that's an even better step. The one thing I think people need to contemplate, though, is that in certain markets, there's not a lot of housing stock available. And so turnover is really important. So if we get rates to step down, which improves affordability, do we see prices reaccelerate? I mean, they're up about 1.5% year over year for housing. Do we see a price acceleration on housing in certain markets, which would again dampen turnover, which isn't great? The other thing I would point out, and everyone talks about tariffs, but a lot of the products sold at Lowe's and Home Depot are tariffed, even if some of it's kind of the inputs to those products. And so that suggests maybe some supply and demand issues as the products come up in price. So, net, we look at the macro right now, and I know everyone's excited. The stock has taken off about 15% in the last 3 or 4 weeks because people thought interest rates are coming down. I think we're just a little bit more cautious on all of that. And we would actually read some of the CPI, PPI data as much more cautious than I think the street has vis-a-vis interest rates. We don't think there was actually as much good news in that data as has kind of been put into the market.
And Scott, the tactic that we have seen on the part of, or the strategy we've seen on the part of Lowe's and Home Depot is to lean into the professional market, right? You have Lowe's buying Artisan Design and also announcing this new acquisition of Foundation for $8.8 billion. Does that help? What does that do?
Well, I mean, I think it's both companies are playing on this idea of the home building market, because there's, a shortage of housing in the U.S., not down here in Florida where we're based out. There's tons of housing down here. But I think it also, there's clues what companies do, right? Both of these big companies are moving away from their core retail business and looking at the pro business. My thought on that is that they're obviously seeing something in that core retail business that's not as attractive as this pro business. Now we'll see if that pans out over the next couple of years. But I do think it's an interesting tell. Core retail is more difficult. Core retail, lots of competition. We haven't talked about Amazon. We talked about Walmart in pricing. Amazon is incredibly aggressive in pricing on the tools and those types of things that are sold at both Home Depot and Lowe's. So I think it is a little bit of a tell on what they think about the retail market going forward. They think there's better prospects in that pro market. Again, we'll have to see if that bet's correct, but they're definitely telling us that. Both companies.
And Scott, you've mentioned Walmart a couple times, so I want to ask you ahead of those earnings, what you think they're going to show. I mean, Walmart has been performing pretty darn well in this environment. Do you think we're going to continue to see that?
Walmart's one of our top long-term picks, has been for a long time. We had a buy on it for 3 years. We stepped aside for a few months this year and then put the buyback on it when it was about $90. We like Walmart over the next 18 months to 2 years. But the things we're picking up in the marketplace right now, vis-a-vis competition in those everyday essential categories, we're seeing people, and this is good for the consumer, by the way. We've seen gas prices down. We may see food at home come down or everyday essentials come down. There is a building amount of competition in that market. We've heard Amazon, adding in their fresh to really compete against Walmart. Our data, again, we do a lot of proprietary pricing surveys, shows that Kroger is now investing in price. We actually don't think they're just using vendor funds at this stage. We think they're also putting their own P&L into that discounting. So I know it's very different than a lot of people, a lot of my colleagues. We are somewhat cautious on Walmart through the end of the year.
So Scott, just very quickly, the bottom line then is margins could come under pressure is what you're saying.
We worry about margins coming under pressure, no doubt, between the tariffs and the price discounting. Now, offsetting that for Walmart, and we'll see this tomorrow, is advertising and their membership business. But we do see pressure on those margins through the end of the year, potentially offset by what I just said.
Right.
And so we'll see what they have to say tomorrow. If it's a good report in this environment, that is, I think, incredibly bullish for Walmart, because there are definitely a lot of pressures right now on some of their core categories.
Scott, great to catch up with you as always. Thank you.
Thanks, Julie. Good seeing you.
A gloomy outlook on the U.S. housing market from building materials giant James Hardie. Those shares are plunging as the company warns that demand for repairs and new construction in North America remains challenging, with economic uncertainty, elevated prices, low inventory, keeping the sector in neutral. Senior reporter Claire Boston is joining me now with a closer look at the sector. And obviously, Claire, this goes along with everything we've been talking about with Lowe's and Home Depot this week, and with some of the home builders trying to figure out what's going on in the housing sector.
Right. I mean, I think when you look at this overall, it's just a really tough time to be in the housing market. You have record bad affordability right now. Mortgage rates are very high. And now if you're a home builder, you're looking at tariffs that are going to drive up the cost of your building materials. Labor costs are rising. ICE raids are potentially a concern that we are starting to see on some of these job sites. And all of that kind of paints a really gloomy picture for these home builders. There's a sentiment index that comes out once a month. We got a reading on Monday, and the index is 32, and anything below 50 is negative. So 32 is quite negative. And, home builders are really saying, what they have is not moving. They're having to cut prices in some cases. They are also having to offer bigger incentives, to move these homes. And it's kind of a weird environment because we do have a housing shortage in this country. But, in some places right now, we are essentially oversupplied. The home builders cannot move these homes. And, that's really eating into their margins. They're pulling back on new starts. And it's a tough time right now for them.
Yeah, I mean, even just the anecdata from Scott Mushkin, who we just spoke to, saying in Florida, they got plenty of houses and they can't move them there. So you see those James Hardie shares down 36% today, that building material company. Toll Brothers also out, and it's supposed to be the luxury end, right? So what kind of vibe are we getting from them?
Yeah, I mean, so Toll they did beat earnings. They are up today, but Toll you have to kind of look at as its own category. They are going after the higher income consumer. Maybe they're a little bit less affordability stretched. Maybe they've sold a previous home. But that being said, the other thing about home builders right now is they are competing with more new supply on the market than they have in several years. This is the first year, pretty much since the end of 2022, that we really saw people listing new homes and putting their homes on the market. And so what I hear, at least when I talk to realtors and home builders, is the consumer has more choice now, and in some cases, maybe they're not going to want that new construction because they want that older home that is maybe a little bit closer to the downtown core where they work. And, that's just putting more competition on home builders right now.
Yeah, not a great picture still. Thanks, Claire. Appreciate it. Coming up, the investor playbook for airline stocks, how to trade that sector ahead of the busy holiday travel season. That's next on Market Catalyst.
All right, with the summer travel season winding down, the holiday season picking up, airlines competing to grab the lion's share of consumer travel budgets. We're navigating how to play the airline sector with the Yahoo Finance playbook. Joining me now is Peter McNally, Global Head of Sector Analyst at Third Bridge. Peter, it's great to see you. So, if we look at the sector, Peter, the ETF that tracks the sector, JETS, you're actually close here to 2025 highs. Summer being nearly over. I'm interested to get your broad take. What did we see? What did we learn about the sector? How solid was it?
Yeah, it turned out to be a good season, overall. I think at the start of it, everyone was concerned about tariffs and a potential recession and revenue declines in the sector. And it turns out like that was not the case. The issues are more the old ones that we've been having 2023, 2024, which were about getting planes, that work and fly and costs. And, within that, the major carriers like United and Delta are at an advantage. They've got about 1,000 planes each. They're not as dependent on new deliveries from Boeing and Airbus. Their costs have become a lot more competitive with low-cost carriers. So they've been competing in the leisure markets a bit more than in the past. But the diversity has played out well. For low-cost carriers, they haven't been as low cost as they once were. The delivery schedules have really impacted them, and it's not just new aircraft; it's also engines as well. Has been a bottleneck for years now, and that's not going away. So those challenges remain, and there's a bit of a haves versus have-nots. But as we said at the beginning, overall, this is a pretty good summer for demand.
What was the demand? How does it break down between consumer and business? What do we see there, Peter?
Well, I think even within the consumer, the big play is this premiumization, right? And let's just take Southwest as an example, which always had the same seats for everybody. They're investing now in redoing their cabins to offer a premium economy. And that is, also the demand for some of these new planes, that it's easier to do that. But within premium economy, this is where United and Delta and American and these guys do make a lot of money. So consumers are, the average consumer is willing to pay a little bit more. The business travel thing never got quite back to, pre-COVID levels. Some business travel got cut out, permanently. But a lot of it did come back. Now, while those are, really profitable customers for these airlines, the big play has been in the premium economy section of the plane.
How generally, Peter, did international look?
International's actually been quite good. I mean, Asia has still been slow, right? China, it's not news to say that the Chinese economy has been weak, and we've got this trade war that continues. But demand to Europe has been pretty good. We've seen less of it coming the other way with European carriers flying here. There has been some pushback there, but as far as Americans going to Europe and South America has actually been pretty good, and this has manifested itself in the results of those big three U.S. carriers that we talked about.
There was a Bloomberg story, Peter. I don't know if you saw this. It noted this interesting trend I want to bounce off you. They talked about how leisure and business travelers are waiting, they say, until the last minute to book air travel. That's interesting. What do you make of that, Peter? What could explain that? What is that? What challenges does that possibly pose for airlines?
Well, look, it makes capacity planning, really tricky. And I think this is something that we saw really at the onset of the recovery post-pandemic. And, again, the advantage is on larger carriers who've got more planes that they can move around to meet this demand as it comes in. But the interesting thing, I think, to watch that we've been doing a lot of work on lately is AI, and how airlines are using that to price, and maybe understanding some of these patterns that are emerging in real time as customers look, to book these things very short term. I think airlines, particularly Delta, we would note, has been effective in pricing to meet that demand that doesn't have a whole lot of visibility.
Do you expect that trend right now? It's Delta, Peter. Is that going to become much more popularized throughout the sector, you think?
Well, look, we think that large carriers like Delta have an advantage, and just they're as well capitalized as any business out there to invest in this stuff. But it's a low single digit percent of sales today. Our experts at ThirdBridge are telling us this could be 20% by the end of this year, and potentially like 50% next year, leading to potentially 2 to 3% pricing growth alone, just from this single trend. And in a low margin business like airlines, like that really can help fall right to the bottom line.
As somebody, Peter, who recently had to book tickets for his family from New Jersey to California, I'm curious, what do you think pricing looks like now and ahead broadly?
Well, for the next few months, it likely eases off. We're through the peak demand season, or we will be in about a week and a half. All right. And then mid-September, right up until about Thanksgiving, we're going to see this dip. But the thing we will be looking, for some more guidance from the companies in the weeks ahead is how much capacity they're planning on adding for the Christmas season. What does that look like? And we saw visibility take a dip there in April ahead of the summer travel season, but it came back quickly in May. So I think really to get to the point of the question, I think you're in pretty good shape as a consumer for September, October, and early November. But for the holiday season, it certainly can be a bit more expensive and pricey.
Final question, Peter. Jet fuel price trends. What are we seeing? What do you expect ahead? What does that mean for the airlines?
Well, this has been a tailwind, and the one thing about fuel is it affects all the airlines equally. Nobody was, Delta owns a refinery, but it doesn't impact the bottom line like that greatly. I think our experts would tell us in the months ahead, oil prices do look weaker. It seems to be an oversupplied market, and that likely put some downward pressure on jet fuel costs in the months ahead.
A wave of momentum in the third quarter among AI, crypto, and even gold ETFs. I want to bring in Cynthia Murphy, Vedify investment strategist, for this week's ETF report brought to you by Invesco QQQ. Cynthia, we talk about stock ETFs a lot here, but obviously there's a lot of popularity in alternative asset ETFs, and we've seen this sort of explosion in crypto in particular. What stands out to you about some of the trends that we've been seeing this year?
Hi, Julie. It's been a moving target a little bit. If you think about where we were in the first half of the year, a lot of defensive positioning, a lot of talking about diversification, which remains a theme. But in the third quarter specifically, a little started on the April 8 low, and it's really picked up momentum here, is the return to this AI theme, the return to growth names, the return to risk on. We're seeing that in the ETF flows. We're seeing a lot of the popular names gathering assets, funds like, the Qs to big tech names and to a lot of the AI ETFs, which there are over 20, almost 30 ETFs in that category today in the market. So it's been an interesting market because we're seeing folks flock to the equity risk, flock to the names that we've known in the past couple of years that have done really well, your large cap, mega cap names, but remain invested in some of the diversification that they've been doing since the beginning of the year. So to your point, Bitcoin, which kind of toes both sides of this conversation between a risk asset and a diversifier, as well as things like gold, which have taken in, gold ETFs have taken in $25 billion in assets year to date and continue to pick up assets as we go forward.
Well, Cynthia, talking about the sort of AI trade as well, given the sell-off that we've been seeing, I mean, what's the relationship between price and flows? In other words, this tech sell-off that we've been seeing over the past few days, do you then see a lag and then flows start to come out of the ETFs? How does that tend to work?
Yeah, that's a great question because flows are a great lagging indicator. It tells you where investors have been, not where they're going. So it could be that it goes either way. It could be that folks get nervous and, we go back to the conversation about overvaluation, really expensive tech stocks, or it goes to, hey, a sell-off means a cheaper price, a lower entry point. So you get some of that buying opportunity also shows up in the space. I think right now the momentum has really been, if you look at some of these stocks, Nvidia, if you look at funds like ARK-K, for example, a fund that we haven't really talked about in a couple of years, and it's a top 10 asset gatherer in Q3 so far. So you see that there's really some interest building here, and whether this is going to be a buy the dip or rebalance a little bit given the run up in prices, I think we'll have to wait and see.
And what about then on the other asset side, where we're talking about things like Bitcoin and gold? What are you sort of forecasting and seeing for the rest of the year for those kinds of assets?
So the crypto assets have a lot of things going for them right now. I mean, as you know, you've covered extensively, a lot of the regulatory framework has really been conducive to investor sentiment. We've done a lot of advisor surveys here at Verify, and advisors are telling us about, better regulatory framework, better clarity on how the government feels about crypto assets is making them more excited about the asset class. So we're seeing investment interest grow in the advisory channel. We're seeing that interest just continue to boom in the retail channel. And we're seeing now institutional players really get into the space, especially in Ethereum. A lot of conversations about building on the Ethereum blockchain, a lot of development there. So it's really has so much momentum in this space right now. It could be that we hit technical levels, the level sets a little bit, we go in, it's not never a straight line up, but the demand has been strong. We've seen over $25 billion into Bitcoin ETFs. We've seen over $10 billion into Ethereum ETFs. And on if you look at all these funds, it's not just your spot Bitcoin ETF. A fund like BTCI, which is a Bitcoin plus income through options, that fund has picked up $500 million this year. So it's widespread through the category, the demand and the interest for exposure to crypto.
Cynthia, thanks so much for catching up with us for the ETF report. Appreciate it.
My pleasure.
Coming up, full market coverage ahead in the second hour of Market Catalyst. We'll be looking at Estee Lauder and its decline today. Next. Coming up this hour on Market Catalyst. First up, Estee Lauder warns of a $100 million hit from tariffs. We'll have more on that and the state of the broader luxury consumer ahead. Plus, as investors prepare for Jerome Powell's Jackson Hole speech, we'll look at the balancing act the Fed chair faces. And new reports shine a light on the state of Meta's AI business. What does that mean for its talent wars and the future of the business? All that and more coming up on Market Catalysts. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here. We do have losses continuing in the NASDAQ. It's leading declines today, off by 1.8% right now. So at the lows of this session, an hour and a half in. But then the S&P 500 is close on its tail. It's down about 1% today. The Dow doing the best of the three major averages with only a 0.25% decline. Well, tariffs are now taking a toll on beauty. Estee Lauder shares sinking after the company issued weak profit guidance as it anticipates a $100 million hit from tariffs. Meanwhile, sluggish sales still aren't picking up in Asia and the Americas. Estee Lauder reporting a 16% drop in skincare sales in its fourth quarter. Joining me now, Filippo Falorni, City Vice President of U.S. Beverages, Household and Personal Care, lead analyst, and Pauline Brown, former chairman of North America at LVMH. Thank you both for joining us. Filippo, as we look at these Estee Lauder numbers, yes, of course, there's the tariff hit, but is the bigger problem the drop in sales?
Yeah. Hi, Julie. Thanks for having me on. Yeah, absolutely. Look, the sales number was pretty soft in the quarter, negative 13% organic sales. The company does expect an improvement in their fiscal 26. They guided to a return to positive sales growth of between 0 and 3%. So I'll call it about 1.5% at the midpoint. But there's still a lot of uncertainty in their business, especially the China and travel retail side, which, they've made some progress, but those markets remain pretty soft. And in the Americas, they also made some progress from a pure consumption standpoint, but the retailer environment remains pretty challenging. They called out retailers reducing level of inventory, and so their actual selling into the channels being still soft in the quarter, and they expect that to somewhat continue into their fiscal Q1 of 26.
Pauline, some of the other beauty brands, though, seem to be doing somewhat better, right? If you look at the likes of a L'Oreal, for example, at least in some markets. Do you think that this is a macro issue, or do you think there's some things here that are specific to Estee Lauder?
Well, I think it's both, but I think their problems way predated issues like tariffs and some of the other macro issues that have hit most companies, most consumer companies. I'm even less bullish than the commentary we just heard. I think the problems run very deep. I think on the headline was around travel retail, the slowdown in China, which persists for many companies, including L'Oreal. The fact that the costs are getting steeper, the fact that they're going through restructuring. I think what is not being talked about enough is the saturation of the marketplace, the shift from prestige to mass, which would explain why e.l.f. continues to outperform. If you look at mass cosmetic growth in the last 12 months or the 2024 period, that was up 4%. Prestige was up only 2%. So it is losing share. And then you look at just the number of brands in the market. There are about 500 in Sephora alone. If I look back in my beauty days 10 years ago, 10 years plus, there were close to 300. So you've got a lot of issues hitting the company all at the same time. Not easy.
Filippo, when you look at the China market, and in the Asian market more broadly, do you think that has hit bottom yet?
Yeah, so that's a good question, Julie, because that's what drove the stock rally into the print. The stock was up about 85% into the print. We actually had a negative view into the print on Estee Lauder just because we thought expectation got a little bit out of hand on terms of this China recovery. Look, the latest big promotional event in China was the 618 campaign, which came in better than expected across the industry. And Estee made some progress from a market share standpoint, but I do think it's still a bit early to call a real inflection in China. The consumer sentiment remains still pretty challenging, and the local brands are doing a lot better. To Pauline's point, there's been a proliferation of brands in the US, but also in China. Like a lot of the local Chinese competition has really improved over the last several years. So I think it's still a bit early to really call out an inflection in China.
Let's talk a little bit more about pricing. And Pauline, to your point, sort of the bifurcation in the market between mass and value versus the higher end. And I got to ask this by way of the LVMH $160 lipstick, which they have just rolled out. There's a lot of buzz about this, both positive and negative. Pauline, where do they fit in? And how worried can we be about a consumer market when you've got this kind of product coming out into it?
I think the Vuitton launch is a non-issue for Estee Lauder, which doesn't mean that Estee Lauder doesn't continue to have a lot of issues in the competitive dynamic. There is virtually no market for a $160 lipstick, especially when you have Hermes setting the top of the market with an $80 lipstick, which is still a very small business for a brand that is now valued at quite a bit more than Vuitton. So I think this was a strategic play to try to reinforce their market position and their market lead. I think it's an extension, but I think it's way premature to suggest that this is going to be a success for LVMH. That's an entirely different set of challenges that they're facing.
Not saved by lipstick then, perhaps. But Filippo, I would ask on the pricing front, if consumers see a product like that out in the market, does it give other brands cover to raise their prices a little bit?
Yeah, look, I think pricing is definitely going to be a lever that some of these companies are going to try to use to offset some of the tariff headwinds that we talked about. For Estee, they called out $100 million in tariff impact. And they did say part of their strategy to mitigate some of it is procurement and moving some of their production more locally, both in the US and in China. But some of it is also pricing. And it's a combination of lower discounts, less discounts in the market, but also some selected price increases. So I do think there's going to be more pricing in the category, in the beauty category in the US in the next 12 months. I think though companies are going to be somewhat judicial in terms of like how much to price higher, given the consumer environment remains a little bit choppy with the potential for trade down to mass, as we discussed before.
I mean, Pauline, even to your point, we've seen e.l.f. raise its prices, right, $1 across the board. What is the sort of pricing power, or to put it another way, what's the ceiling on how much some of these brands can raise prices?
Yeah, well, I do think it's more interesting to think about the floor than the ceiling. To me, the consumer's smart, and a consumer that might buy a Creme de la Mer moisturizer for $200 still won't be, in my opinion, comfortable with a ceiling that is much above $50 for a lipstick. And that's not because of affordability, it's because of fairness and value perception. But when it comes to the floor, and I'm very sympathetic to e.l.f.'s position, they are dealing with a very price-sensitive customer and one that and a very thin margin. And they've played that line historically very, very well in terms of offering almost Mac-like propositions at less than Maybelline prices. And they're being squeezed at that end, but they're still outperforming, which says to me that this is more than just a macro issue. It's a performance issue, and it's an operational issue that we're seeing with Estee Lauder.
Right, and that's obviously reflected in the shares. Pauline, one more fun one for you. While we're talking about viral lipstick, expensive lipstick, I also have to ask you about viral stuffed animal keychains, right? And the whole Labubu craze that we have seen. And again, I guess my question is, again, of some kind of a version of like, how worried can we be about consumer spending in a world where you've got this kind of a craze for these things?
Yeah, I mean, this is entertainment. And one thing in good times and bad, we don't stop doing things that amuse us, that distract us, that bring a little bit of color and joy and whimsy into our life. And so that's what this is all about. Do I think a year from now we're going to be talking about these accessories or these characters? Absolutely not. But if I were a manufacturer of them, I'd be going all out while, striking while the iron's hot.
Yes, as we have seen with so many trends before this one that brought some fun and whimsy to people's pocketbooks or what have you. Filippo, Pauline, good to see you. Thank you.
Thank you. Thank you.
Thanks for having me.
We got much more markets action coming up. Stay tuned. You're watching Market Catalysts. Federal Reserve officials heading to Wyoming for the annual Jackson Hole Economic Symposium. It's kicking off tomorrow, with Fed Chair Powell set to speak on Friday. Now, this comes as Powell continues to face pressure from President Trump to cut rates. Joining me now is Dean Baker, Center for Economic and Policy Research co-founder and senior economist. Thanks for being here, Dean. So how are you seeing the economic backdrop right now, and what do you think the case is for the Fed to cut or not?
Well, it's a tough situation. The economy is growing slowly in the first half. It grew 1.2% in the first half of the year. Consumption just grew at a 1% rate. It's very hard to see it picking up much from there. If I had to say faster or slower, my bet would be slower because we have a lot of things that drag on the economy. Most importantly, the tariffs. That's pulling money out of people's pocket. And as President Trump keeps saying, it's a lot of money it's pulling out of people's pockets. So we're looking at a situation where growth was already slow, likely to slow further. And at the same time, we are seeing higher inflation. Again, tariffs are the big story here. I should throw in the mass deportations. That shows up because the people being deported, many of them were picking our crops, picking our fruit and vegetables. Those prices are going higher. So we're in a situation where Powell is looking at both an economy that's clearly slowing, but at the same time, we're seeing higher inflation. So it's a tough call. I mean, if he calls me up, I'd tell him to lower rates. But, he might well see it differently.
I think a lot of market participants, certainly those that are pushing those Fed Fund futures buttons, are feeling the same way, Dean. And of course, the backdrop as well is the political backdrop, right? And the pressure that the Fed chair is under, that he has thus far been very resistant to, as the Fed is an independent body. But then you see other things percolating. There's a report today, or I guess President Trump has said, that he would potentially seek to remove Lisa Cook, who is one of the Federal Reserve governors, over allegations of some sort of mortgage malfeasance. What do you make of that situation, the sort of broader pressure that the Fed's been under?
Well, frankly, I think that's likely to make it harder for Powell to lower rates because he's determined to try and defend the Fed's independence. And again, I know nothing about what Governor Cook did or did not do, but I just saw a short article in the paper. This was reported by the head of the Fannie and Freddie oversight. He's obviously going through their records, looking for violations of President Trump's political opponents. This is something that should put someone in jail for. I mean, what he's doing, not what Governor Cook did or didn't do, which I'm not in a position to comment on. But this is not what the U.S. government is supposed to be doing. So I suspect that if that's intended to pressure Powell to lower rates, I will expect Cook will not resign. But again, I can't comment on her situation, but I expect she's not going to resign. And I think if anything, it will make Powell and the other governors less likely to lower rates because they're determined to preserve the Fed's independence. And that means you don't respond to a president bullying you.
Dean, we're going to get Fed minutes this afternoon, and we know there were two dissenting voices on the Fed Open Market Committee. we're going to get probably another voice, not at the next Fed meeting, but the one following, in the form of Stephen Myron. What does that dynamic mean for that decision-making process? Again, also with this external pressure.
Yeah, you have 12 people on that committee, so Powell still commands the overwhelming majority, and I think they're determined to make decisions in good faith. And again, I think there's a good argument for a rate cut. So I wouldn't say that Powell won't do. I mean, he's not going to do. I forget. I think President Trump was asking for a 300. He's not going to do a 300 basis point rate cut. If they do a rate cut, it'll almost certainly be a quarter point, and that may well happen. But I don't think it's going to be because President Trump has stacked the deck. And again, that might be counterproductive. There's a history there of trying to form a consensus. And if you have people arguing in bad faith, that doesn't help you form a consensus.
Dean, I also want to ask you, you wrote recently that you do see the economy slowing but not going into recession, but you talked about the possibility of a tech stock crash as something of a wild card here because of the effect it could then in turn have on growth. We've been talking about that a little bit for a while as valuations have crept higher and higher and higher, and it hasn't happened yet. I mean, we've seen some pullbacks, but nothing huge. What do you think the likelihood of that is, and what would be the trigger?
Well, I remember the 90s tech bubble. And again, I tried to keep my view quiet in terms of when it was going to burst, because I probably would have said, in 6 months, beginning 2 years before it actually did burst. You can't time a bubble. I was following the housing bubble as well, and I was very convinced there was a bubble. And there I was very openly saying, there's a bubble, there's a bubble, there's a bubble. But again, it lasted way longer than I ever would have thought. So what's going to cause it? When's it going to burst? What's going to cause it? I don't know. I claim very little expertise on AI. I've read some people who do have expertise. And the big thing that strikes me, well, two big things. One, there's not a clear profitability case there. I mean, it might be great technology. It doesn't necessarily mean that you're going to see, OpenAI or whoever chalk up huge profits from it. The other is, it looks like China's really moving ahead. They have much more efficient technology. And the other big thing is they have basically unlimited access to cheap electricity. And as we know, that's a huge, huge problem here. So between the two of those, I think they have a lot of advantages. And again, I'm not one to really talk with great expertise about AI, but people who are seem to think that China's moving ahead there.
Yeah, and to your point, Eric Schmidt recently writing in an opinion piece, the New York Times, that he thinks our U.S. obsession with AGI, artificial general intelligence, is leaving the Chinese to outpace us. But we'll leave that discussion for another day. Dean, your expertise is in the economy. And if we do get a pullback in the markets, talk to me about the feedback loop then in terms of economic growth.
Well, there are two big things here. One is the AI sector itself has been a big source of growth in an otherwise very weak economy. I mean, ordinarily, if we had an economy growing 2.5%, 3%, AI, here I'm talking about the investment in AI, wouldn't be that big a deal. But an economy that grew 1.2% in the first half, it is a very big deal. So that will be a direct hit. The other is there will be a hit on consumption. So we saw that going back to 2000 when we saw the tech stocks plummet, consumption weaken. So it won't go through the floor, but there is this wealth effect that if people see their 401ks are suddenly worth 10 or 15% less, not a prediction, I'm just saying a hypothetical, they will cut back. So those will be the ways that a collapse of the AI bubble will have a direct hit to the economy.
Right, a sort of reversal or backing up of the wealth effect. Dean, thank you so much. Good to catch up with you today.
Sure, thanks for having me on.
Thanks. Coming up, commentary from the Lowe's CEO after earnings. Plus, we've got some of today's other trending tickers. We'll be right back. Lowe's shares trading little changed after it reported better than expected earnings per share for the second quarter. It also announced plans to acquire Foundation Building Materials. Yahoo Finance senior reporter Brooke DePalma got the chance to speak with Lowe's chairman and CEO Marvin Ellison. Brooke, what were your takeaways from that conversation?
Yeah, Julie, it seems like Lowe's is really positioning itself for this rebound in the housing market. They did see a return to positive same-store sales growth during the quarter, and now they're really banking on when consumers will return to those larger discretionary projects. Taking a closer look at what exactly I heard is that they're preparing for that turnaround by investing heavily in the professional business, those services that are larger, big-ticket items here. We know that they acquired FBM, that's Foundation Building Materials, for approximately $8.8 $2.8 billion. That's on top of a recent acquisition of Artisan Design Group. Marvin Elvison, the CEO there, did tell me that this gives it the ability to give a large pro customer a full suite of options, including interior finishes, drywall to doors, installation, ceiling systems. And he went on to say that consumers are waiting for more confidence in the economy before they spend on these big ticket items. During the quarter, they did in fact spend on these smaller to medium pro projects like appliances, paints, flooring, and that's what drove ticket size up, but transactions were roughly flat. He said, quote, large discretionary projects are still being deferred. He went on to say that getting a kitchen redesigned in your home, getting your bathroom remodeled, those are discretionary purchases. And he said consumers are saying, hey, you can wait another 6 months, you can wait another year if need be. And the third point I really tried to ask him here was, when will this inflection point happen? And he said specifically, we're not planning on any type of inflection to happen in their guidance. But he did say this. He said that they're waiting for a sub 6% mortgage rate to be a catalyst here. He said, quote, based on the feedback of analysts and our own internal data, we think a sub 6% mortgage rate may be a catalyst to getting the home inflection point started. He went on to say that is more of a hypothesis, but they call it the lock-in effect, where people are just in a home that may be too small, that may not be exactly what they want, but they have such a low mortgage rate that they're just kind of stuck, and they're trying to wait and see if they can get a low mortgage rate that gives them confidence that they need to really pick up and move and perhaps upgrade their home. And so lots of momentum leading into the back half of the year for Lowe's.
And Brooke, what about tariffs? What did he say about that?
Yeah, well, what's interesting is, as we've been hearing from so many retailers, we do know that they have been doing or dealing with tariffs in 3 different ways, including lower their dependency on sourcing from outside the U.S. They also said they've been negotiating with suppliers. And he also said the key point here, and what they really learned in the second quarter, was this lean into price and value. In July, they saw same-store sales growth up nearly 5%, and that was largely because they leaned into promotions, they leaned into their Lowe's rewards, into that loyalty customer, and they expect to do the same thing as we make our way back into the back half of the year, and especially into that key holiday season. So promotions will be the name of the game heading into the back half, because that's what drove ticket size higher, and ultimately consumers back in the door during the second quarter. They said they learned a lot from that.
Sounds like it. Now time for some of today's trending tickers. We're watching Hertz, McDonald's, and Intel. First up is Hertz, the company reportedly planning to sell pre-owned cars via Amazon Autos. That's according to CNBC. Brooke DePalma is still with me here. So this really creating a ripple effect, because we've got Hertz trading higher, we've got Carvana trading lower, as people have more ways to buy cars online.
Yeah, really interesting. This is actually Amazon's first time, or rather Hertz will be the first fleet dealer on Amazon Autos. And so that's why you're seeing this excitement among investors right now. The stock now up nearly 6% or nearly 5.5% in this midday trading session. But then on the flip side, you're seeing Carvana down about 3% after Carvana has been one of those stocks that has gotten so much attention year to date, up more than 60%. But if you take a look at Hertz, it also has gotten similar momentum year to date, up more than 50%. So this will really allow Hertz to sell those used cars on Amazon, which sounds like a futuristic concept to me, if you ask me. But they're going to sell brands like Ford, Toyota, Chevrolet, Nissan. And once again, this is pretty significant because this will be the first fleet dealer on Amazon Autos, and that is given to Hertz. And perhaps that's why you see some pressure on Carvana right now.
Yeah, those shares down about 3%. Next up, let's talk McDonald's. Shares are rising there. The Wall Street Journal is reporting the company is planning to lower the cost of its combo meals. It had to get the buy-in, Brooke, from its franchisees to do that. But, you know, it just emphasizes that value is the name of the game here.
Value absolutely is the name of the game here, and McDonald's is really hoping to regain that leadership when it comes to their value proposition. We know that this company, this fast food chain, has really struggled lending share to those fine dining, fast casual restaurants that gained momentum in the middle of last year as consumers really look for their best bang for their buck. And we did see same-store sales here in the U.S. reverse to the upside from McDonald's last quarter. They jumped about 2.5% in the company's fiscal quarter. But customers really want more here. They want more value, more bang for their buck. And so what we know is that McDonald's and its U.S. franchisees agreed to keep the cost of 8 popular combo meals about 15% below the sum of the individual item prices. That's according to those materials viewed by the Wall Street Journal. But it'll be interesting to see how this all plays out. But they also have that McValue meal they've been trying to lean into. Also, the return of the snack wrap, which has me excited. So right now, we see investors certainly pleased as well.
Yeah, it looks that way. And finally, let's talk a little bit more about Intel. We've been talking about Intel all day. Now there's a new report from CNBC that Intel's in talks with other large investors to get an equity infusion, but at a discounted price. Now, this comes amid SoftBank's $2 billion investment and, of course, what the White House is reportedly weighing, taking some sort of stake in the company. So we've been watching those Intel shares closely. We had a discussion about this earlier. Right now, the shares, Brooke, are down by 6%.
Yeah, Intel's been quite on a ride over the past few days. It's leading the NASDAQ 100 lower. If you could see at the YF Interactive, over the past 3 days, Intel stock is down more than 3.5%. And this has been quite the ride for Intel as they've gotten sort of this mixed picture as they're trying to make way into the AI revolution. We know that with that potential of the Trump administration trying to get involved, we know that Commerce Secretary Howard Lutnick said that the U.S. government must receive an equity stake in Intel. But this is a company that has truly been on a tear year to date. It's up nearly 18%. Not as much as the other AI players that we've seen, but just so much back and forth over the past few days with this company's stock as well.
Yeah, definitely. And there probably will continue to be. Thanks, Brooke. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. The Port of Los Angeles had its busiest month ever in July, processing more than 1 million 20-foot equivalent units, or TEUs. The surge came ahead of the steep tariffs imposed by the U.S. on August 1st. And Yahoo Finance spoke to Port of LA Executive Director Gene Soroka about how tariffs are changing the import landscape.
It has been an unbelievable roller coaster of a ride, and it's not over yet. What we've seen is that when hard trade policy goes into effect, the cargo declines rapidly. Then when those policies are eased and deadlines extended, the cargo picks up one more time. So many were looking at the July 8th deadline. Then it was the August 1st, then August 7th, and August 11th with respect to China. So importers were just trying to get in under the wire, and did they? Best month ever in the history of the Port of Los Angeles. And to me, the telling statistic was not one ship backed up.
What was coming in, Gene? I mean, broadly in terms of categories, was it furniture? Was it electronics? What did you see?
Finished goods and parts for American factories almost equal. On the finished goods side, furniture, clothing, footwear, electronics, and toys leading up to the all-important holiday season. On the parts side of the business, a wide scale, but especially focused on the automotive tiered suppliers.
And now the question is, what do you see ahead? What do you forecast? What do you estimate?
August does not look bad. We may come in between 900 and 950,000 container units. That would represent a 7 to 10% drop compared to July. So we're not falling precipitously, but a noticeable decline. And we probably will look back and say July was our peak, which if in fact it is, a little bit earlier than normal. After that, we're going to see decline simply because the year-on-year comps were so high and the fact that we've got so much inventory now in the country.
Based on what you're seeing at your port, Gene, add it up to us. What does this all mean for the American consumer?
It's going to be interesting because most importers continue to tell me that their prices have risen dramatically. Anywhere from 15 to 55% tariffs now exist, depending on where you're shipping from. But realistically, the big box retailers, home improvement stores, were able to pad their inventories for months on end. They're going to burn through that stock eventually. It's the small to middle-sized importers that are dipping into cash reserves in order to buy and pay those exorbitant taxes or for tariffs, once the cargo lands here in ports like Los Angeles, they're going to have to pass on those costs at some point, and that may be very soon.
Let me ask you, Gene, because listen, we're all trying to figure out on this show how big a deal we think tariffs are going to be ultimately for companies. We did speak recently with Jerry Storch, the CEO of Storch Advisors, and it was interesting, Gene, because he doesn't see tariff impact as necessarily a big deal. Just take a listen, and then I want to get your reaction on the other side.
I think that the impact has been overblown. People have worried about it too much. And I'll point out, we haven't seen it yet. And I understand what everyone's saying. Oh, it's coming. The goods that come in for the fall, they're going to be the one that show all the tariffs. But just keep in mind, a lot of the products aren't imported at all and don't have any tariffs on it. I don't think we're going to see some kind of big explosion here, on the net downside in terms of operating results.
Gene, what do you make of Jerry's comments there?
Well, I think we should point Jerry to Detroit and have him speak to General Motors and the Ford Motor Company after their quarterly results. On the consumer side, we've seen the bigger companies absorb a lot of these costs as well. They're going to have to start passing them on just a little bit. Explosion? No, but we'll see a noticeable uptick in the price online as well as at the store shelves.
Gene, I want to talk China before I let you go here. I'm curious, what percent does China now represent of your business, Gene, versus, let's say, 5 years ago, 10 years ago?
That's a good question, Josh. We're at about 45% and declining. Our entire business portfolio made up of China imports and exports. It was 60% dating back to 2018. We've seen a strong shift in sourcing and manufacturing to Southeast Asia, locations like Vietnam, Indonesia, Malaysia, and that will continue based on the merchandisers and importers we talk to on a regular basis. Big change.
Final question, Gene. A big reason President Trump is imposing these tariffs is because he wants more stuff made here, right? Long term, let's say that happens, Gene. I'm curious how well your port is positioned and would be positioned to handle that.
A couple things we have to look at. One, if manufacturing is to come here, we need a sector-specific review. According to the National Association of Manufacturers, we still have 414,000 manufacturing jobs open today. We've got to work on that, the talent and the geography. But let's say this all works. There'll be more exports, and these companies will try to find new markets. We'll be ready here in Los Angeles. Every 4 containers create a job, regardless of which direction. We'll be ready here.
It's late August in Jackson Hole, Wyoming, where a media frenzy converges around top finance and economic officials. A fly fishing invitation in the early 1980s turned into the world's most watched macro meetup. What Fed Chair Jay Powell says here can set the tone for U.S. economic policy into year end. That's right, we're talking about the Fed's Jackson Hole Symposium on today's Stocks in Translation. First, what is it? It's the Kansas City Fed's invitation-only economic policy get-together. Each August, central bankers, academics, financial ministers, and select investors gather to debate economic policy. There's no formal vote, just signals. The symposium got its start in 1978 as a regional Fed gathering. By 1982, the Kansas City Fed, they moved it to Wyoming in Jackson Hole to lure the chair of the Fed, Paul Volcker, an avid fly fisherman, and he showed up. The rest is market folklore. And after the global financial crisis, these August remarks became a thing that investors watch and sometimes trade. So let's highlight now what Jackson Hole is and what it is not. It's a policy symposium, a gathering to discuss big economic trends and ideas. It's speeches, papers, and debates. But don't call it a Fed meeting. There are only 8 official FOMC meetings each year, and Jackson Hole is not one of them. There's no formal action, no vote, no interest rate decision, and no economic projections. But the Jackson Hole Symposium isn't just Fed officials, it's central bankers, finance ministers, and top economists. They're comparing notes, stress testing ideas, and sometimes they tip the next chapter of policy. The guest list is very small, but the echo is global. The conversation here sets the tone for the months ahead, and after the summer ends and everyone gets back to business, well, that's when the policy making starts. Taking stock of some of the more notable years, we had to begin with that 1982 meeting that snagged the interest interest of Fed Chair Paul Volcker. That set an important precedent. But the meeting would not be closely watched by investors for decades. You're going to notice the next year on the list is 2010. With the global financial crisis still fresh in everyone's minds, Chair Ben Bernanke teased options for so-called QE2, lighting up the possibilities for a huge new round of monetary stimulus. Stocks rallied and investors paid attention. And just a few years later, Mario Draghi, head of the European Central Bank in 2014, flagged weak inflation expectations. This set up a big central bank pivot in Europe, once again providing important market signals. Fast forward again to the pandemic year of 2020, and Chair Powell outlined a brand new policy, target inflation. It had been in the works for years, and it was an important shift in Fed policy. Now, here's what investors are going to be listening for this year. The Fed has two mandates from Congress to consider: maximum employment, meaning a solid job market, and stable prices, which means the Fed needs to pay close attention to inflation. So, if Powell sounds optimistic about employment, that it's tight, or that wages are still growing at a firm pace, well, then that signals he's less inclined to cut rates to stimulate. That's what's called hawkish. And on the other hand, if Paul talks about the job market cooling or that wage growth is losing a bit of steam, that suggests that more rate cuts are on the horizon, which is called dovish. And when it comes to inflation, any words like sticky or stalled progress signal hawkishness, and talk of a broader cooling of prices or any disinflation, that's dovish. This might be an oversimplification, but you get the picture. Bottom line, it's a small room that can provide big signals, and what officials say there can set and reset fall policy expectations across rates, stocks, and the dollar. Not every year is seismic, but the chance of a giant reveal keeps investors tuned in, and the media coverage adds to the frenzy. Tune in to Stocks in Translation, the podcast, for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts after the break.
The white-hot competition for AI talent in big tech is only getting hotter, but lucrative offers don't always translate into high morale among workers. In New York Magazine this week, tech columnist John Herman pulls the curtain back on Meta and how the company became, as he put it, uniquely toxic for top AI talent. He's joining me, as well as Dan Howley, Yahoo Finance tech editor. John, you know, Meta's been making all these headlines because it is spending enormous amounts of money to draw individual, AI programmers and researchers, et cetera. But what's wrong in that equation?
I mean, as you said, the market for AI talent is incredibly hot. There aren't a whole lot of people who have the expertise necessary to build a cutting edge model. But if you're one of those people, you are, first of all, probably a true believer in some sense that you believe you're building something that could be really consequential, potentially dangerous. You also probably want to be part of a company that's going to win. And so you look around and you see OpenAI with ChatGPT, a clear leader. You see Google with tons of resources, really strong models, and leadership that you identify as like fellow, true researchers. You see Anthropic, popular with programmers, led by people who are really concerned about AI alignment and safety. Maybe you see xAI, and for some people, Elon Musk's backing and involvement will be a turnoff, but for others, it's a chance to work with, one of the great entrepreneurs of the area and to move really fast and aggressively. Then you look at Meta, and you see a company that's clearly trying to catch up. You see a company that's probably going to use your models to build chatbots on Facebook and Instagram, and you don't really hear a coherent pitch. And that's just what you see from the outside. That's, before you even start talking to other people who work there.
Yeah, John, there's obviously the Meta AI app that's kind of basically just a warehouse for AI slop at this point. Nothing really interesting unless you want to see Fish Jesus or something, literally something that you can see on there. What does that mean for the morale, of these people that are working on this, right? Not just the, I'm not working on research, I'm not, working with Elon Musk or something like that, but they're putting out these products, they're under the gun, right? This is obviously Mark Zuckerberg going hard at this, deeply involved, and then they turn out something like this. What does that do for these workers? And, are the big paychecks enough for them to say, all right, well, I'll just keep on keeping on if I'm getting this payday?
Yeah, Meta's lackluster products so far and their sort of weak general purpose models are a real liability for their recruitment. And it has been punishing for the morale of the people who already work there and who've been working on them. There's a really deep well of AI talent that's been at Meta for a long time. And they kind of missed the boat on the first wave of chatbots. Clearly, they're catching up. There's a lot of pressure from the top. The internal efforts are incredibly disorganized. And as you said, the first products are kind of a mess. They're not as good as, products from a year ago from the other big labs. And that's troubling if you're there, in addition to this constant fear of getting fired and being reorganized or put on a different project all of a sudden, which is really a shift in Meta's culture in the last couple of years. It used to be seen as kind of a generally good place to work where you could do difficult but quality work, where your compensation was good and where the culture was, if not ideal, fairly tolerable. Now you're both scared and working on these strange chatbots that in comparison to maybe the programming tools that you see from Anthropic, or even just the general cutting edge chatbots from OpenAI and Google, it feels like you're working on garbage. And so that kind of explains why Meta is making such huge offers, in addition to Mark Zuckerberg's desire not to miss this wave. But it also tells like a slightly different story than I think some of the reporting did initially about those offers. There is a war over talent, but it's not a $1 billion a head war. That's Meta's problem. That's because they can't recruit the same way that OpenAI can.
I'm also curious about work culture, right? Like, I think we still have stuck in our heads the sort of Silicon Valley, i.e. the sitcom vision of the world where there's games and it's colorful and it's fun and like all these perks. You mentioned the sort of 996 culture in your piece, 9 hours a day, 6 days a week. Is it 9 hours a day? That even seems short. But, how is that sort of shifted?
I think Meta and a lot of other big tech companies were seen up until fairly recently as really secure and good places to work. You were paid well, you had a lot of freedom, and you had more security than people in the rest of the economy. It's almost like you had gotten your ticket out of the traditional economy. Meta, particularly after the COVID era tech boom, really started cracking down on or pushing back against this perception among their own employees. And sort of Mark Zuckerberg in particular emphasized, inspired in part by Elon Musk's work at Twitter, that you could lose your job, that you need to produce, that this is sort of a cutthroat place and you should think of this as very competitive. Now, he has his reasons for doing that, and you don't want your employees to be, just idling or too comfortable or whatever if you are an aggressive CEO. But I do think that his very public emphasis of this shift in the culture is coming back to bite the company a little bit. This is a company that's been performing extraordinarily well in financial terms, but that has been laying people off consistently for the last few years. That has really been unsettling for people in the industry. And if you know that you have in-demand talent, you might take that talent somewhere where not only do you feel more secure, and maybe you will be working crazy hours, and this is becoming more common at AI startups, but you're going to take it somewhere where you feel like you believe in what you're doing and you have the backing of your CEO. You're more likely to accept that sort of 996 style schedule if you're working at a company that, where you think you're building the next great artificial intelligence model that's going to change the world. And I don't think too many people see Meta as the firm that's going to crack that.
John, I just want to ask real quickly, Meta, obviously doing this, they don't want to miss the boat. They missed the boat on the smartphone, but they did try to launch their own smartphone at one point. That fell apart entirely. The metaverse, that's kind of out in the ether, no pun intended. Does Meta risk messing up AI at some point because of this kind of internal chaos?
I think they do, and Meta's focus on the metaverse and heavy investment in the metaverse and its redirection of internal talent to those efforts was part of the reason that it was kind of behind the 8 ball with AI. And what I think, beyond this specific episode in Meta's history, this repeated pattern, with the avatar of Mark Zuckerberg, of seeing what appears to be a growing trend, spending tens of billions of dollars on it, and then being forced to move on to the next thing is a problem. It's a reputational problem. And I think people see a lot of that in what Mark Zuckerberg is doing now. His messaging about AI has been all over the place. He's talking about friendship. He's talking about super intelligence. He's writing memos in the style of AI CEOs that are just totally out of character for him. And I think there's a little bit of a disingenuousness or opportunism that people sense there, and that's a turnoff if you are an idealistic, focused engineer.
Right. Well, we'll see how it plays out. John, Dan, thank you. That's it for Market Catalyst. I'm Julie Hyman. Thank you for watching. We got more Yahoo Finance coming up.